Welcome to Illuminati Silver. We tell you the truth about silver. Today is Sunday, the 17th of October 2021, and we're looking at an article which suggests that the United States may indeed be facing a recession in 2022, in spite of all of the talk of economic growth. Is this the case? Well, before we look, just a quick shout out to a video we produced this morning entitled Gold and Silver's Rise Curtailed by Stronger Than Expected Retail Sales Figures. And we've placed a link to that in the description box below. So let's now take a look as to whether we're going to have economic prosperity or a recession next year. So let's now take a look at this Forbes article dated the 14th of October, so it was 3 days ago, entitled "The United States Economy May Be Facing Another Recession, New Research Suggests." Now we have to say this was written before the retail sales figures came out on Friday for the United States, which were higher than expectations. They weren't amazing figures, but they were better than what the markets expected, which then suggests, potentially, when you tie that in with the relatively good jobs figures, the likelihood of the Fed introducing tapering of its bond buying program, because at the moment it is buying $120 billion worth of bonds, a mixture between mortgage securities and treasuries, for the want of a better description. It plans to reduce those purchases eventually to zero. That's the plan. They say long before they'll consider raising interest rates. However, whilst the news so far has been quite good, this article is suggesting something slightly different moving into 2022. Let's just have a quick read. The US economy may be heading for another downturn within the next 6 months if sagging consumer expectations, because those figures have been poor, are any guide, according to new research from ex-Bank of England member David Blanchflower. It's a counterintuitive prediction given all the talk of recovery and inflation fears permeating the economic debate at the moment. US gross domestic product, GDP, soared an annualized 6.7% in the second quarter, while consumer prices are running at 5.4% in the year to September. But Blanchflower, now at Dartmouth College, and his co-author Alex Bryson, suggests the above figures are merely offering a look into the rear-view mirror. Quote, "It seems to us that there is every likelihood that the United States entered recession at the end of 2021, unquote. The authors write in a new research paper. The most compelling evidence is from the Conference Board expectations data for the 8 biggest states. They say a recent sharp decline in the jobless rate to below 5% has been driven by unusually supportive fiscal policy, masking other signs of weakness in the outlook. Those figures show drops comparable to those seen in 2007, just before the start of the Great Recession, which was the worst in generations. Blanchflower notes forecasters totally missed that downturn, despite warning signs from housing and finance that something was awry. By the spring of 2007, qualitative data pointed to a recession coming in a few months, and this was ignored, he says. Today we report equivalent evidence for the US showing comparable declines, suggesting that the US is entering recession now, at the end of 2021. Now that's quite an interesting approach, or viewpoint. Let's continue for a moment. The call stands in sharp contrast to private sector forecasts and those of Federal Reserve officials, who see the US economy expanding 5.9% this year and 3.8% next year. Against that backdrop, officials are planning to scale back their $120 billion in monthly bond purchases starting in November, and financial markets have started to price in the first interest rate hike as early as mid to late 2022. The Fed appears to be headed for premature tightening, said Blanchflower. The Fed missed the Great Recession, and the concern is they've missed the next one. Blanchflower and Bryson's results hold over a long historical period, giving them additional confidence in the prognosis. Quote, we show consumer expectation indices from both the Conference Board and the University of Michigan predict economic downturns up to 18 months in advance in the United States, both at national and at state level, they write. All the recessions since the 1980s have been predicted by at least 10 and sometimes many more point drops in these indices. So, we have a scenario where the news looks good because when you compare the economic damage that was done during the coronavirus pandemic lockdowns, of course, any rise appears positive. Added to that, the copious amounts of stimulus injected into the economy by central banks and governments around the world, of course, we're going to see an element of growth. The issue is, has there been enough stimulus to ensure that growth can continue automatically, or will it immediately stop once that stimulus is withdrawn, which inevitably it has to be, because although theoretically central banks can just keep printing money, which they are, everyone knows there comes a point at which then that currency becomes essentially worthless. And whilst they know long-term that is going to happen, they want to kick the can down the road and make that date as late as humanly possible. In other words, so that, for those in charge, it's not on their watch. Now, our view is that Biden's stimulus package will be introduced, his infrastructure bill. It will come out, and that will boost markets again. Central banks, and particularly the Fed, knows what it's like if the equity market collapses. And we also have a scenario, many people forget this. The number of people entering retirement now is increasing to such an extent that you actually technically have a smaller workforce looking after more retirees, which is why in a number of countries the pension age has been increased. Because that is happening, then pensioners are reliant in the United States on their 401ks and state benefits, in the UK on their personal pension plans, company pension plans, and again state benefits. If the equity markets collapse, as most, not all, but most pension plans are heavily invested in equities without guarantees, then those pensioners' incomes will drop significantly, and their wealth too. And as they are forming a larger part of the population, then that will ultimately lead to economic destruction. And this is something that central banks around the world, it's their hidden secret as to why they are so intent on ensuring that equity markets remain positive. They can allow for 5 and maybe 10% dips. 50, 60, 70% retracements, if they occur, they can't be allowed to last for long. And the economic hemorrhage that will induce, they won't allow that to happen for as long as they possibly can. So with that in mind, we think there will be continuous stimulus injected into the economy. We will have tapering short term. There'll be talk of raising rates, and in some countries there will be rising rates. The United Kingdom may tentatively increase rates by 0.25% in the not too distant future. But the amount that they can increase them to is limited. We saw that in the last decade, where the Fed could only get them up to about 3%, and then they had to reduce them again. There's every possibility they may not even get beyond 2% in the next 5 years. What do you think? Do share your thoughts. Of course, the effect on gold and silver long term will be positive. Short term could be negative because the concept of bond buying and so forth will act as headwinds. But then equally, if we have the scenario whereby more money is pumped into the economy, then that technically devalues currencies over time and act as a tailwind for gold and silver prices. Do share your thoughts. Thank you so much for listening. Please, if you haven't done so, do subscribe to our channel, give us a thumbs up, press the bell sign. Have a great day. Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.